Welcome to the Deep Dive. We are jumping straight into one of the most intriguing strategic moves in the global agricultural inputs sector this year, the Mosaic Company's decision to divest a century-old asset.
That's right. We are unpacking the recent sale of Mosaic Potash Carlsbad, their New Mexico operation. And this isn't just, a simple property transaction.
Not at all.
It's a critical financial maneuver, a very deliberate, sharp turn toward portfolio rationalization that, it dramatically reshapes Mosaic's focus. And it raises these huge questions about the true cost of asset ownership in the mining industry.
So the mission for you today is to get a thorough understanding of this pivot. Why did Mosaic sell this mine? I mean, the price tag was surprisingly modest at $30 million. But if we dig into the details, you start to realize that the real value in this deal wasn't the cash they received, but the massive decades-long liability Mosaic was finally able to shed.
We have absolutely dissected the transaction details, analyzed the unique geological and environmental hurdles that are just inherent to mining potash in the U.S. Southwest. And we'll show you why this divestment allows Mosaic to pivot entirely to its core higher return operations up in Canada.
So we're looking beyond the revenue line.
Way beyond. We're focusing on the weight of operational complexity that the new owner, International Minerals Carlsbad, is now inheriting.
Okay, let's unpack this transaction then. The headline figure is $30 million for an entire operating mine complex.
Right.
That number immediately feels low, considering the essential nature of the product. I mean, potash is vital for global food security.
It is.
So let's start with the financial nuts and bolts. How is that $30 million structured?
Well, it's not all cash immediately, which is important. The sale price of $30 million is split. International Minerals Carlsbad is paying $20 million in initial cash at closing, subject to, typical adjustments.
Okay.
The remaining $10 million is deferred cash consideration.
And when did they get that?
They won't pay it until later. It's spread across 3 equal annual installments beginning in 2029.
A 4-year delay before the deferred payments even start. I mean, that sounds like a strong signal that the immediate cash flow from this asset was way less important to Mosaic than, say, cleaning up their balance sheet.
Precisely. And that brings us to the truly crucial detail, the core of this whole transaction.
Which is?
The buyer assumes full responsibility for all asset retirement obligations, or AROs, associated with the Carlsbad operations.
Okay, and those AROs, just to be clear, they represent the immense, often multi-century costs of environmental remediation, mine closure, and long-term monitoring required by regulation.
Exactly, it's the big one.
So if the asset was only valued at $30 million, and that figure includes the machinery, the land, the reserves, and the intellectual property, what's the implicit cost savings Mosaic realized by transferring those AROs? I mean, was the real cost of those liabilities potentially far higher than the $30 million they received?
That is the essential question here. While Mosaic will report a non-cash asset impairment charge in the fourth quarter of 2025.
Right, which is just an accounting thing.
It's an accounting consequence of selling an asset for less than its book value. But the strategic benefit is massive. Those AROs carry huge estimates, often running into the hundreds of millions of dollars over the lifespan of the remediation efforts.
Wow.
So by transferring this liability, Mosaic has secured a massive future capital expenditure avoidance. It turns the $30 million into a premium for strategic focus.
And speaking of value, this wasn't just physical infrastructure either. International Minerals Carlsbad also acquired the IP.
Correct.
That includes the well-known potash brands K-Mag and Dynamate. Are these just generic names? Or do they represent a specific type of product that commands a premium?
Oh, they are definitely not generic. This is where the product chemistry comes in. K-Mag and Dynamate are premium, high-margin specialty fertilizers. They are derived from the unique geological deposits in Carlsbad, which contain the minerals langbeinite and sylvite. They're low-chloride, sulfur-rich sources of potash and magnesium.
Which is crucial for what?
Crucial for high-value crops, sensitive to chlorine or crops growing in areas with high soil salinity. Retaining the brands and the IP is key to the buyer's future profitability.
Okay, that clarifies the commercial value. So Mosaic sheds this massive liability and refocuses on its absolute core. What's the overarching strategic rationale for focusing solely on Saskatchewan, Canada? Why are those assets so much better?
Well, it comes down to scale, geology, and operational efficiency. The Saskatchewan deposits are amongst the largest and highest quality in the world. They typically allow for massive economies of scale that the older, smaller, and geologically more challenging New Mexico mine just couldn't match.
Right.
So this move allows Mosaic to consolidate capital investment, reduce management complexity, and dedicate resources to modernizing their most profitable production platform.
I mean, it's a classic move in a mature commodity sector.
It is. Shed the complexity, focus on being the low-cost producer.
So if that's the financial and strategic story, let's talk about the heavy lifting. This is where it gets really important for the new owners. If the price was only $30 million, what operational and environmental baggage comes along with a 100-year-old mine in the arid Southwest?
Well, the complexity is baked right into the geology itself. Potash deposits, critical for providing potassium to global agriculture, are marine evaporites.
Meaning they formed when ancient seas evaporated.
Exactly. And they are buried deep, usually 400 meters to over 1,000 meters down. That depth requires massive infrastructure and complex engineering just to reach the ore.
And in Carlsbad specifically, they weren't using the newer technique of solution mining,
No.
where you dissolve the salt and pump it out. They were using conventional methods.
Correct. The Carlsbad operation utilized mechanized underground mining, primarily the room and pillar method.
So creating huge caverns underground.
Right. Hauling the ore, which, as we mentioned, is a mix of langbeinite and sylvite up through 2 separate shafts. Underground ops require constant ventilation, dewatering, specialized equipment. It's far more capital and labor intensive than solution mining.
And how much are they moving?
Between 1 and 10 million tons of raw ore annually. It requires continuous, rigorous maintenance.
Now, let's pivot back to those environmental liabilities that really define this sale. We mentioned the AROs, but let's give the listener the concrete, tangible picture of what the new owner has to manage for, well, potentially the next 100 years.
Yeah.
What are those 3 major waste streams generated during potash processing?
This is where the long-term cost resides. Potash beneficiation, the process of separating the valuable potassium salts, generates enormous quantities of waste that you can't just, throw away. You have 3 primary streams.
Okay, what's first?
First, the salt tailings. These are huge volumes of impure sodium chloride, effectively common salt, that has been extracted alongside the potash. This material is typically stacked on the surface in massive piles that can be hundreds of feet high and cover vast acreage.
I need you to put that scale into perspective for me. When you say massive piles, are we talking about the size of city blocks or bigger?
Imagine a massive hill of industrial salt, millions of tons of it.
Wow.
These piles, or tailing stacks, require highly engineered, expensive capping systems to prevent water infiltration.
Because if rainwater hits the stacks...
It leaches highly concentrated salt brines into the surrounding soil and potentially into groundwater. It's a massive environmental hazard in an arid region like New Mexico.
Okay, that's one. What's the second waste stream?
The second are the brines, highly concentrated salt water, often with magnesium chloride, left over after the valuable minerals have been crystallized out.
And the third?
The third stream is the fines, which are the insoluble slimes, essentially the clay, sand, and dolomite that was in the original ore body.
So you have these salty liquid and solid wastes. How is the new owner expected to manage both the brines and the fines long term?
They have 2 primary options, both extremely costly. They have to retain the brines and fines in massive surface ponds relying on evaporation, which is a slow process, or they have to resort to deep well injection. And deep well injection is highly regulated and expensive, forcing the brines into deep, confined geological formations hundreds of meters below any freshwater sources.
And both of those require constant monitoring.
Continuous, multi-decade environmental monitoring to prove they are not contaminating local aquifers. This is why Mosaic was so eager to transfer that obligation.
And beyond the waste, there are local operational challenges the new owner has to address immediately. You mentioned New Mexico is defined by its water scarcity. How does that impact things?
Water management is absolutely crucial and non-negotiable. The operational nuances are highly specific to the region. We know that other operations in the area, historically, the Mississippi Chemical Corporation had to pipe water from distant freshwater aquifers.
They couldn't use local groundwater?
Couldn't rely on it. It was too high in total dissolved solids. It was essentially too salty already. So International Minerals Carlsbad is inheriting that vast, complex, and potentially politically sensitive infrastructure for external water sourcing.
That also highlights the social complexity. Sharing water infrastructure often ties the mine into local community politics, especially with ranchers and agricultural users.
Exactly.
It's not just an engineering problem, it's a social license problem.
It is. And let's not forget air quality. Even in processing the dry ore, significant dust is generated. The site had sophisticated emission controls in place, like bag houses and wet scrubbers, specifically to capture that fine dust during processing, like when the ore is dumped from the skips after coming up the shaft.
So if International Minerals Carlsbad is inheriting all of this, deep geological complexity, challenging water sourcing, 3 major waste streams, let's turn to the market implications. What does this massive strategic prioritization by Mosaic mean for the broader agricultural sector?
I think it signals that the fertilizer industry is becoming even more concentrated and intensely focused on cost efficiency. This divestment confirms a long-term forecast. Major companies are willing to sacrifice legacy assets to maximize return on the highest quality, most technologically advanced operations.
Because fluctuating energy costs and unpredictable global trade patterns make maintaining marginal assets too risky.
Exactly.
So what are the key points decision makers in the U.S. Southwest, farmers, co-ops, competing producers? What must they be monitoring now that this major regional supply chain has shifted hands?
They need to monitor operational stability first and foremost. International Minerals Carlsbad is betting on building upon the region's 100-plus-year potash legacy, and their principals collectively boast over a century of experience.
So they have the expertise.
They have the expertise. But if they stumble in managing the liabilities or the operational complexity, it could lead to disruptions. Regional stakeholders have to assess their ability to maintain high production volumes to ensure the long-term reliability of supply and, crucially, monitor local pricing strategies.
The buyer is obviously confident. Their CEO called this an exciting business opportunity. But what is the specific risk they're assuming that Mosaic has now avoided?
Well, the biggest risk is the long tail of the environmental liability. If they face unforeseen geological or regulatory challenges in managing those massive tailing stacks or deep injection wells, the remediation costs could balloon dramatically, completely overwhelming that $30 million initial asset purchase.
Right.
They have to prove they can manage an aging asset with modern, sustainable standards without catastrophic cost overruns.
And for Mosaic, the narrative shifts entirely to growth and optimization. Their imperative now is effectively redeploying that $30 million and the significant capital they saved by offloading the ARO maintenance. Where's that capital likely headed?
It's headed toward the future. We expect to see those resources directed toward efficiency upgrades and logistics improvements across their Canadian platform, solidifying their low-cost status. But perhaps more interestingly, it could go into advancing their Mosaic Biosciences platform.
What's that?
It's a platform focused on developing next-generation biological solutions for improved nutrient use efficiency in farming. So it's a move from dealing with 100-year-old physical infrastructure to investing in cutting-edge agricultural technology.
So this deep dive really highlights that successful M&A isn't always about acquiring massive revenue streams.
No.
It's often about surgically removing long-term, expensive operational and environmental complexity to allow a company to focus on superior capital-efficient assets. Mosaic consolidating around its Canadian production is a case study in strategic simplification.
It clarifies their strategic map for investors and competitors alike. Focuses on the future, not legacy cleanup.
So for you, the learner, here is the final provocative thought. Given the scale of the waste streams, the mountains of salt tailings, the persistent brines, and the decades-spanning environmental liabilities Mosaic transferred, how much of that $30 million sale price was genuinely for the remaining recoverable potash reserves, and how much was simply the cost of paying a highly experienced operator to take over the permanent, expensive burden of the asset retirement obligations?
Our analysis suggests Mosaic is now laser-focused on extracting maximum value from their core Canadian potash and phosphate assets.
Now, for our segment, this is not financial advice. This information is strictly for educational purposes and should not be used as the basis for any investment decision.
Okay. Our outrageously plausible trade idea relies on the critical assumption that the new, smaller, focused ownership of the Carlsbad mine will struggle to maintain perfectly consistent logistics and pricing in the U.S. Southwest, at least initially.
Therefore, the outrageous but plausible trade idea. Short shares in a major North American regional logistics company operating heavily in the U.S. Southwest fertilizer sector. The bet is that any unforeseen operational hiccups, logistical delays, or changes in regional pricing strategy under the new ownership will cause temporary volatility and confusion in the regional supply chain over the next 18 months.
Which would lead to a dip in their localized shipping volumes and margins.
Bet on temporary chaos where regional supply reliability is concerned.
Exactly.
That's all the time we have for this deep dive. Thank you for joining us as we unpack the true cost of legacy assets. We'll be back soon to tackle the next big market move.